Welcome back to the KDPG Sunday edition. This morning we're talking about the national economy, and now we're going to talk a little bit about how that might affect you as an investor. We have three great guests this morning, and they are Bob Fragasso. He's the chairman and chief executive officer and founder of Fragasso Financial Advisors. Rip Applegate is senior financial advisor and director of fiduciary plan solutions at DBR and Company. He is also heard each weekday morning on his Money Talk segment on News Radio 1020 KDKA. And Lou Stanislalovich is founder, CEO, president, and chief investment officer at Legend Financial Advisors and Emerging Wealth Investment Management. Thank you again for all being with us this morning on the KDPG Sunday edition. You all have clients. You try to steer them and guide them as to where they need to be invested. A lot of times what makes the difference is what kind of, what makes maybe you different than Bob or Rick is what sector you decide to try to guide your client to invest in. So, having said that, am I correct on that, by the way? That makes the difference between all of your different companies. So, going back to the moment, I stole some headlines from the Wall Street Journal on Friday and also CNBC. Rare market leadership from industrials raises stakes for trade talks. So, are industrials something people should be looking at again?
We would say no. Historically, the three big growth sectors typically do well late in the cycle, and I would term the cycle as being in extra innings.
Okay.
Okay. Meaning if a few decisions are made the wrong way as the stock market sees it, we could go retract 10% pretty easily. For example, if they shut down the government again, if the trade talks just shut down completely, all of that, of course, they would both reopen again, but
sure.
Nevertheless, the market might retract 10% in 5 days, or less even.
And the industrials you feel would be hit on that?
Definitely, but we think, again, the best places are in technology, healthcare, and to a limited degree in retailing or consumer discretionary.
Okay. Bob?
I agree with Lou.
Historically,
We're
that's the way it's been.
De-emphasizing, but not abandoning the industrials. Our methodology is to cover all of the asset sectors, all of the industries within each asset sector, both domestically and internationally. Where we do our fine-tuning is on the percentage allocation to each. Why? Because we never know. You said the dynamic nature. Right. We are in a high volatility period, which, by the way, if we have time, we should do a historic retrospect on volatility. It wasn't invented in this period of time. It goes all the way back. But yet, staying power with the right portfolio construction, however it's done, and having determination to stay with it, will guide through that and get you to where, with no guarantees, but get you to where you need to be. So having said that, all sectors, but the devil's in the details. How much are we committing to each?
Yeah. I think that the game is late in the ninth inning of the economic cycle. I think Lou's point about the things that tend to do well in that late cycle are starting to be seen. I don't think you can negate the election that changed the composition of the House of Representatives, which would indicate more inclination to try to talk about industrial spending a la improvements in the infrastructure of America, which would spark that industrial sector more if we can get a bipartisan Congress to act together. So I do think there's some opportunities in that to not overlook with the industrial sector. Longer term plays, I think, are absolutely correct, that you look to the technology, you look to those other industries and keep positions in each to some percentage. But I also think we need to be aware of the fact that right now we're looking at a slowdown with an overlay of uncertainty in Washington, D.C. that's going to affect just about everything. One last point on that, Stacy, is keep in mind that the best performing asset class last year, right, was cash, something we haven't seen for a long time. So a 1.7% average return on cash is an asset class that I would say that we're probably going to be looking at more of.
All right. Now, one of the things that obviously is driving this market right now, either up or down, on Friday morning, the Dow was up 300 points based on hope that the trade talks are going to go somewhere. But in the past, as you like to point out, Bob, you have to take a historical approach. It wasn't that long ago that the price of oil was making a big impact on this on the stock markets and all the markets, as a matter of fact. Another headline, this one from the CNBC: oil prices are rising and poised for a breakout. So is that true? Is that where we're headed next, and how is that going to affect the markets?
Certainly oil prices could rise. We hit a low, okay, we went from 80-something down to 40-something. We're starting to see it creep back up, but then it started retracting again in the last couple of days. So, part of it, the big thing, or the big source of oil that most people didn't expect worldwide 5 years ago was the fracking. And the fracking has allowed the U.S. to be now the largest producer of oil and natural gas in the world, even exceeding Saudi Arabia and Russia. So there are some major changes there, and we're becoming more self-sufficient. We actually export oil today, okay? That hadn't happened in almost 70 years. Okay, we've used everything we produced, and now things have really changed around. And it seems as if the prices get to $50, $60 a barrel, guess what? We're going to produce more oil via fracking because more wells will be drilled then. And we don't need Russia and Saudi Arabia.
Yeah.
I find it interesting that, as Lou pointed out, that when we had the crisis before, it was because we had to import, and we were at the mercy of whatever other country from which we were importing. A lot of natural gas, et cetera, is being produced.
That's the right point.
In this area, Bob.
Yeah, that's it's perception and supply-demand imbalances will cause prices to rise or fall. But then let's bring it from the blind side, and natural gas is eating oil's lunch in many uses. You see the buses, you see the cars, and you see the industrial uses going to natural gas. I have a whole house generator that I've attached to my house, and it's plumbed to the gas line so that I can run my electricity in an electrical failure on natural gas. We're sitting on the epicenter. That's going to make a big difference. It's not a coincidence that Shell is building a cracker plant right here in our backyard. So that's going to keep the price of oil down, and we're moving more toward electric cars. So I agree with you, Lou, the price it's not a coincidence, it's where fracking begins to make sense.
Sure.
Will it go up $10 a barrel, $20 a barrel? Maybe, on perceptions or a temporary imbalance. But I think the enduring has to be, the underlying economics has to be based on what we've just said.
So basically what you guys are saying at this moment is that you don't expect the economy to be adversely affected by a rise in oil like we've seen in the past.
I would agree with that statement.
I would too. And I think another point to what Bob is saying is about the alternatives that continue to be developed, not at the same pace we'd like to see. But you do have solar and wind and battery-driven considerations.
Oh yeah, 10 years ago they laughed at that,
That's
but
right.
now it's viable
That's
for
right.
a percentage of our energy.
We only have about 2 minutes to go,
go.
but I want to delve very quickly because I want to leave the last minute for something else. The new Green Deal, or the Green New Deal, as they're calling it. Thoughts on that? Is that going to have an impact if something like that goes through?
Yeah, I think that, again, to the opportunity that corporations did get by the reduction in taxes, which they've not spent as we would hope they would spend them, would they think to retool to the future by redirecting their energy sources and production of manufacturing, et cetera, into the greener America that's coming? I think we could be a leader in that. I think we should be a leader in that. So I think that there is tremendous investment opportunity in what we're talking about in that regard.
All right, we only have about a minute to go here. This final thing, everybody looks at not the S&P or the NASDAQ as much as they look at the Dow Jones Industrial Average. And the Dow, as we mentioned, jumped 300 points on Friday morning. Are we going to see this continued major moves like in the hundreds and anywhere from 200 to 500 points?
I promise you we will have volatility over the next 12 months. And right now, when you get big jumps, that means volatility is not that high, but volatility as measured by what's called the VIX index, and anybody can look this up on the internet, just put it in VIX and it'll tell you, once you get above 20, that's when things become worrisome. When we're down near barely double digits, we're in good shape. That's a good time to invest.
Good time to invest.
Volatility helps create efficient markets. It's not a bad thing. It becomes a bad thing when people react emotionally to volatility and bail out and make a changing price level a real loss.
All right. Rick, very quickly.
300-point increases I don't think are going to continue. That's headline driven. The market is a weighing machine, not a voting machine. Take the voting off the table. I think you get a more relaxed environment looking ahead.
Gentlemen, thanks so much for being with us this
Thank
morning
you.
on the KDPG Sunday Edition. We'll be back in just a moment.